Welcome to TalkTickers. We're diving straight into the Alexander and Baldwin first quarter 2025 earnings call. Our job today is to pull out the key insights for you.
That's right. And A and B, well, they kicked off the year with a pretty strong quarter. Beat expectations, both internal and external ones.
Okay, good start. So what are the headline numbers telling us?
Well, the big one is same-store NOI growth, net operating income for existing properties. That came in at 4.2%.
4.2%, solid. What drove that mainly?
Mostly driven by increased occupancy, getting more spaces filled.
Right, and those occupancy figures look good too. Leased occupancy was, what was the number?
Leased hit 95.4%. That's up both from last quarter and year over year, so good momentum.
95.4.
Yeah.
Okay. And economic occupancy, that was also up, wasn't it?
Yeah, significantly, jumped to 93.9%.
And just to remind folks, economic occupancy factors and things like rent collection, it's maybe a slightly more real-world number than just leased.
Exactly. Leased is signed contracts. Economic is closer to cash in the door. Both heading up is, well, is what you want to see.
No doubt. And that feeds into the overall CRE NOI, the commercial real estate income.
It does. CRE NOI was up 4.6%, hitting $33.2 million. That's a non-GAAP figure, of course.
Got it. And leasing spreads, how do they look on renewals?
Still pretty robust, 10.2% on a comparable basis.
10.2%. So they're getting good rent bumps when leases turn over. Shows pricing power.
Demonstrates exactly that. They're commanding higher rents in their markets.
Okay, let's talk bottom line. FFO per share, funds from operations.
Total FFO landed at $0.36 per share for the quarter.
36 cents. How did that break down between the core business and, say, land operations?
Good question. So $0.30, the bulk of it came from their main CRE and corporate ops. The other $1.06 was from land operations.
Okay. And those land ops, they had some specific contributors this quarter, I think.
They did. Benefited from about $2.2 million in gains, mostly from selling agricultural land.
Okay, selling off some ag land.
And there was also a favorable resolution from an old joint venture contingency that added roughly another $3 million to the land operations FFO, kind of a one-off boost.
Right, a bit of legacy cleanup helping the numbers there. What about costs? G&A.
Good news there, too. General and admin expenses were down 3.4% compared to Q1 last year, came in at $7 million.
So they're keeping a lid on overheads.
Seems like it. They're projecting full-year G&A to be flat or maybe even slightly lower than 2024. Ongoing effort, it sounds like.
And the balance sheet. Leverage, liquidity.
Looking pretty healthy. Net debt to adjusted EBITDA was reported at 3.6 times.
3.6. That's generally seen as quite manageable in the REIT space, right?
Very manageable. And they've got over $300 million in liquidity. Gives them flexibility.
Plus, their debt structure seems quite favorable, mostly fixed.
Yeah, huge chunk. 97% of their debt is at fixed rates. Weighted average interest rate is just 4.65%.
Wow, 97% fixed at 4.65. That's great protection in the current environment.
Absolutely. Shields them quite a bit from rising rates. And they declared the Q2 dividend, too, $2.2225 per share. Shows confidence.
Okay, 22.5 cents. So, summing up the results, strong quarter, good occupancy, solid leasing, cost control, healthy balance sheet. But then we look at guidance. They raised the total FFO guidance for the year, but kept the guidance for the core CRE and corporate FFO and the same store NOI growth unchanged. Why the caution there, do you think?
Management pointed directly at macroeconomic uncertainties, the broader economic picture. Even though Q1 was strong, they seem to be hedging their bets a bit for the rest of the year on the core property business.
So taking a prudent stance given potential headwinds, the total FFO raise reflects the Q1 land ops beat then?
Primarily, yes. More confidence in the land segment's full-year contribution after that strong start.
Okay, let's dig deeper now. That 4.2% same-store NOI growth in the CRE portfolio. You mentioned occupancy, but was there a standout property?
Yes, definitely. A big lease signed at their Kaka'ako Center. That's in Oahu. That single lease significantly boosted that property's leased occupancy up to 95.6%. Had a real difference to the overall number.
95.6 for Kaka'ako Center.
Wow.
And they're not just managing existing assets, they're making strategic moves too. This ground lease at Maui Business Park. Tell us about that. It sounds different.
It is quite different for them. They executed a 75-year ground lease on about 5 acres there with a self-storage developer.
75 years. So A&B owns the land long-term, the developer builds and operates the storage facility, and A&B gets ground rent.
Exactly. It converts that commercial land to a steady, recurring FFO stream. They estimate it'll add nearly a penny to FFO this year, 2025.
Just shy of a cent. And it's their first move into self-storage, right? Is there potential for more involvement?
It is their first venture into this specific sector. And yes, there's an option or potential opportunity for A&B to actually take an equity stake in the facility itself later on.
Interesting. So testing the waters potentially. It aligns with their Hawaii focus, but adds asset diversity.
Precisely. Self-storage can be quite resilient, less tied perhaps to economic cycles than some other commercial property types. Fits their strategy.
Okay, a notable strategic step. How about just the bread and butter leasing across the rest of the portfolio? Any highlights beyond Kaka'ako?
Yeah, it was a decent quarter overall for leasing activity. Signed 42 leases that covered about 237,000 square feet. Should bring in around $5.6 million in annualized base rent.
Good volume. And didn't they have a specific industrial vacancy they were working on filling? At Kaka'ako again, I think?
You're right. They'd previously flagged about 50,000 square feet of industrial space there. They've made really good progress. About 75% of that is now backfilled.
75%. That's great. What kind of space was that?
It included leasing 2 whole floors, actually, over 60,000 square feet in total. It was a mix, some storage use, and also some office space that had been vacant within that industrial property.
Okay, filling up a tricky vacancy. I thought I heard something about a contingency tied to that lease, though. Anything to worry about?
There is, yes. A tenant contingency linked to some capital work A&B needs to complete, but management sounded pretty confident it'll get resolved smoothly. And importantly, they said the space is already contributing economically, so rent's flowing.
Okay, so economically contributing, even with the contingency outstanding. Good to clarify. Let's swing back to land operations. The $2.2 million from ag land sales feels somewhat regular, but that $3 million JD resolution boost, that was more of a one-off, right?
Definitely a one-off gain from that specific legacy JV issue. Management did sort of signal that as they continue simplifying that part of the business, other legacy items might pop up in future quarters, could be positive, could be negative.
So potential for noise there, but nothing specific expected near term.
Correct. They don't anticipate any major items like that in the next, say, 3 quarters.
Understood. And on costs, the G&A decrease. Is that trend expected to stick?
Well, their guidance suggests they're aiming for it. Projecting full-year G&A flat to slightly down versus 24 implies, ongoing discipline. They seem focused on efficiency.
Makes sense. And we touched on the balance sheet strength, low leverage, high fixed-rate debt. Seems like a solid foundation.
It really does. That liquidity, over $300 million, gives them dry powder. And the debt structure provides real stability against interest rate volatility. It's a strong position.
Okay. And circling back one last time to guidance.
Yeah.
Total FFO up, core CRE flat. The increase is land ops.
Yes.
And you mentioned the Maui ground lease FFO contribution.
Yeah.
How does that fit into their initial growth plans for the year?
Good point. They had initially factored in about a penny of FFO from general growth initiatives into their guidance. This Maui ground lease essentially delivers that expected contribution. So it's already covering off what they hope to achieve from new growth this year, at least based on initial plans.
Got it. So that initiative is already bearing fruit, basically.
Effectively, yes.
Now, about those macroeconomic clouds they mentioned, what specific worries did they highlight? Tariffs, tenant health.
They did acknowledge the general uncertainty, mentioned tariffs specifically, particularly potential impacts on construction costs. They even noted an 8% jump in steel prices recently.
Ouch. How are they handling that?
They mentioned they'd mitigated some of that impact through pre-purchasing steel. Smart move.
Okay. And tenants, are they seeing signs of stress?
It's interesting. They said soft data, like maybe surveys or anecdotal chats, suggests some tenants are getting a bit worried about the economy. But the hard data, actual leasing activity, rent payments, tenant financials, that all still looks positive. So a bit of a disconnect there currently.
Something to watch then. The difference between sentiment and actual performance.
Exactly. Need to see if the hard data starts to follow the soft data, or if tenant worries remain just in worries.
And the market for actually buying or selling properties in Hawaii, is anything moving? Are they looking to acquire?
Sounds like it's been pretty quiet lately. Management said the Hawaii retail and industrial transaction market hasn't seen many closed deals recently, but their investment team is definitely active, screening opportunities. They sounded hopeful, maybe, that some deals could come together later in the year.
Okay, market's slow, but they're looking.
Yeah.
That covers the call pretty thoroughly, I think. Which brings us to our this is not financial advice segment. Always fun. Based on this A and B call, what's an outrageous but plausible trade idea you've cooked up?
All right, well, leaning into that strategic move A and B just made, their first step into self-storage via that Maui ground lease, with potential equity upside later. And thinking about broader trends like, ongoing urbanization, maybe downsizing, people needing storage.
Okay, I see where you go.
Here's the idea. Consider, hypothetically, a long position in some publicly traded self-storage REITs, specifically those focused on high barrier to entry markets, maybe like A&B's home turf in Hawaii, or similar places where land is tight and demand is strong.
Long self-storage REITs in tough markets. What's the hedge? Or the outrageous part?
Well, to hedge against general real estate softness, or just for the pairing, maybe consider a short position in traditional retail REITs, particularly mall REITs. The ones maybe facing more pressure from e-commerce, experiential retail shifts, that sort of thing.
Okay, long niche storage, short traditional malls.
The outrageous bit is really betting on self-storage to significantly outperform, even thrive, potentially, in a somewhat uncertain economic climate while other sectors might struggle. The plausible part comes from A&B's own strategic move. They clearly see value there, and the known resilience of needs-based sectors like storage.
Interesting pairing. Betting on a specific niche's resilience against broader potential headwinds.
Exactly. But, and this is crucial, this is purely a speculative thought exercise, brainstorming. It is absolutely not financial advice. Do your own deep research, talk to a professional, understand the risks before ever considering any investment.
Absolutely. Standard disclaimer applies. Do your own homework. Food for thought only.
Okay, that wraps up our deep dive on the Alexander and Baldwin Q1 2025 earnings call. Hopefully this breakdown gave you some valuable insights into their current state and where they might be heading.
Yeah, lots to chew on. That self-storage move is definitely one to watch.
For sure. What do you think about their entry there, and how concerned are you about those macroeconomic factors hitting their core business later this year? Keep digging, keep analyzing. Thanks for tuning in to TalkTickers. We'll be back next time to unpack another key earnings call.